Look at this damn chart and admit it. You got played. The things you call indicators, MACD, RSI, moving averages, aren't tools. They are traders planted on your screen. They are engineered to make you react late, to buy after price has already ripped 80%, and to sell when the market is already exhausted. Indicators are not compasses pointing you toward profit. They are coded curses designed to turn your account into a battlefield, delivering clean liquidity to Wall Street sharks who harvest it effortlessly. If you still rely on them, you're not a trader. You're a pre-programmed victim. Now open your eyes and face the truth. You've been stripped of your capital by design. Here's the brutal reality. Indicators were never created to help you make money. They exist to turn you into a passive reactor. They chain you to the past with cold, lifeless math, making you believe you're in control of the market when you're really nothing more than a liquidity source for those who actually hold power. When you stare at divergences or crossovers, you're not seeing the market. You're seeing its leftovers. When you think you're getting an objective signal, you're really looking at a manufactured illusion meant to make you greedy and fearful at the same time. A sideways market is the real nightmare. During those choppy sessions, indicators transform into silent executioners. MACD crosses up, then back down. RSI taps the midpoint, then reverses for no reason. Bollinger Bands tighten, then expand, flooding you with signal after signal, false opportunities designed to drain you. Every entry based on an indicator is a fee paid straight to your broker. Every losing streak is a psychological gut punch that erodes your confidence, so when the real move finally comes, you freeze. Indicators numb your ability to act decisively and turn you into a puppet in smart money's hands. You believe RSI or MACD divergence will flag a reversal. You believe moving average crossovers will reveal a new trend. But when you act on them, you're not just late, you're responding inside a trap engineered to maximize your losses. Smart money doesn't look at indicators. They watch the predictable herd behavior that indicators produce. When MACD crosses up or RSI hits a level, they know exactly what you'll do. They use algorithms to shove price into your stop loss, scoop up liquidity, and continue the real trend. Indicators turn you into a walking map for the players pressing the real buy and sell buttons. You think you're in control, but you're being hunted. Even worse, you voluntarily handed over your emotions and your capital to outdated formulas. You learned to read colors, divergences, crossovers, but you stopped learning how to read money flow. You no longer know when the market is truly strong, when it's being absorbed, or when it's about to reverse. You only see signals, and those signals decided your fate long before you clicked the button. If you want to survive, you must rip off the shell of false certainty. You must learn to read price action, feel volume, and understand market context, accumulation, distribution, trend. Indicators should be a side note, never the reason you take a trade. You need to reclaim control, escape the herd trap, and respond like the one holding power, not the prey. The truth is, most new traders enter the market with one fatal belief. If I find the right indicator, I'll win. What they don't realize is simple. The more popular an indicator is, the more useless it becomes. When millions of people do the same thing at the same time, that's not an edge, that's a weakness. Wall Street doesn't pay for common knowledge. It pays for the person who sees what the crowd doesn't. It pays for the trader who reads price, reads flow, and spots what the entire market overlooks. Indicators are nothing more than paint over the liquidity hunting machine. You think you're trading the market, but you're actually trading the indicator, and the indicator has been trading you for a long time. Every signal is a psychological trap. Comfort when it says buy, panic when it flips. You're scared of a naked chart because it doesn't give you certainty. You need the green and red to soothe your fear, and that fake sense of safety makes you easy to manipulate. Every early exit from fear, every late entry from doubt, each one erases your potential profit, drop by drop. Indicators also build the illusion of control. You think you're following objective rules. If line A crosses line B, I buy. In reality, you're avoiding independent thinking. You're not analyzing structure, reading candle language, or sensing momentum. When a trade loses, you blame the indicator instead of your lack of understanding. And that keeps you stuck in the endless cycle of searching for a new formula. And when you zoom out, You'll realize this: you're handing your stop loss location to the big players. Millions of retail traders place stop losses around the same indicator zones. Smart money doesn't need to guess. They just push price through those areas, wipe out liquidity, and collect the profits from your forced exits. Indicators are treasure maps for predators, and you're the easiest target in the room. The psychological death is worse than the financial one. You become addicted to signals. You fear facing the raw market. You stop making decisions for yourself. Wall Street exploits this ruthlessly. Indicator-dependent traders are perfect targets for algorithms and funds. And do you know what's even scarier? Tweaking indicators, backtesting, hunting for the perfect settings. You think you're optimizing, but you're just explaining the past. Markets shift every second, from flat to volatile, from trending to consolidating. Indicators overfit to history, and when the environment changes, the system collapses. The people who consistently make real money know one truth: no indicator is eternal. Only principles and adaptability survive. Let me tell you about Jones, someone I met in a private group, introduced by a friend who had worked on a small trading desk in Chicago. The first time I saw his chart, I knew instantly I was looking at a trader who'd been crushed from the inside out. His screen was plastered with tangled, multicolored lines, like a web woven from fear and confusion. Nobody had to explain anything to me. Just by looking at Jones's chart, I could read his entire painful history: the late entries, the stop-loss hunts, the false confirmations that pushed him against the trend, and above all, the desperation hiding behind the indicators he clung to like a torn life raft in a black ocean. Jones didn't start as a loser. He started the same way you did, the same way I did, the way every ambitious new trader begins, believing that with enough tools, enough knowledge, enough indicators, he'd win. You know what kills a trader faster than anything else? It's not lack of knowledge. It's not lack of discipline. It's blind faith in the very things designed to mislead him. Jones was the perfect example. I still remember how he spoke about his system with the same zeal a believer would defend a religion. He opened his chart and pointed at his MACD, RSI, stochastic, volume oscillator, Ichimoku, ADX, Bollinger Bands, EMAs, SMAs, VWAP, introducing them like an unbeatable army. But when I asked him a simple question, what does this price reaction actually mean? Jones froze. He looked at price like it was a complete stranger, as if the candlestick chart were just a background for his indicators to run on. And in reality, that's exactly what it had become. He no longer saw the market. He only saw signals. The cruel part is this: Jones wasn't unique. He was the archetype the market loves most: a programmed trader, a perfect target. Jones told me he made money his first month using indicators. Sounds familiar, doesn't it? Everyone wins in the beginning. That's the bait. That's how the market creates belief. Like a dog rewarded with a treat, Jones thought he'd discovered the secret, convinced that MACD plus RSI was the formula to beat the market. Then he added Bollinger Bands, then a volume oscillator for confirmation, then 2 more EMAs for certainty. The more signals he had, the safer he felt. But Jones had no idea how smart money actually operates. They don't look at indicators. They look at him, at where he places his stop loss, where the herd clusters, where someone like him will react on autopilot. Every time MECD crossed up, hundreds of thousands of little Joneses fired buy orders. Every time RSI hit oversold, they tried to catch the bottom. Every time the Bollinger Bands tightened, they thought a breakout was coming. But the market doesn't care about their imagination. The day Jones got hit the hardest is the day I'll never forget. He described it with a cracked voice, like he was recounting an accident that took a piece of his soul. He got what he believed was a perfect signal. MACD crossed up, RSI cleared 50, stochastic bounced from oversold, volume ticked slightly higher. Every indicator agreed. He told himself, this is the one. He went long. 2 minutes later, smart money shoved price straight into the liquidity pocket where Jones hid his stop loss. His trade was wiped out in seconds. One red candle swallowed the entire breakout he thought was a divine signal. Jones didn't lose because he was wrong. He lost because he viewed the market through a fogged lens. He didn't see the liquidity grab happening right in front of him. And then he did what most retail traders do after getting hit. He optimized his indicators. He tweaked the MACD settings, changed RSI from 14 to 12, added another EMA, removed Bollinger Bands, then put them back, tried double divergence, smoothed RSI, MACD histogram breakout, an endless chain of tweaks he believed would rescue him from chaos. He backtested obsessively, and as always, the past looked beautiful. The past always convinced him that this time he'd fixed it. But tomorrow's market never looks like yesterday's. Indicators are just models of history. They don't know where smart money wants to hunt liquidity today, whether they want to drive it up or smash it down, whether they're accumulating or distributing. Indicators only react after the damage is done. Jones never realized that. Then came the day he blew up, not from a single trade, but from a cascade of mistakes, each one leading into the next. The first loss came from lagging signals. The second came from trying to get even. The third came from trusting MACD divergence. The fourth came from FOMO. The fifth from losing emotional control. As he told the story, I saw the same thing I've seen in countless retail traders: the collapse of self-belief. He no longer understood why he was losing. He couldn't distinguish market noise from his own errors. His psychology was shredded by the dozens of contradictory signals he relied on for certainty. And the irony? The more indicators he added, the less certainty he had. One night on a long call, Jones asked me, "Why is it always me? Why does the market always go straight for my stop loss?" I didn't give him advice. I just told him one thing: because you're playing exactly the game the market wants you to play. Jones went silent for a long, long time. The tragedy runs even deeper. Jones had become addicted to indicators. He couldn't look at a raw chart. He couldn't make a decision based on price action or volume. Every flicker of red or green was a psychological jolt, a command he felt obligated to obey. He turned into a machine, reacting to the rhythm smart money had programmed for him. And each time he failed, he went back to optimize the system, hunted for new signals, and extended the losing streak. He wasn't just losing money, he was losing the ability to think independently. Jones is the most brutal example of what happens when you place your faith in indicators. He started as a normal trader with ambition, but ended as a victim of his own blind trust. Hundreds of indicators on his chart didn't protect him. They turned him into the perfect target for liquidity hunters. Every signal was a trap. Every colorful line was a map guiding smart money straight to his capital. And as he watched his account drain away, he finally saw the truth. Price action, volume, context, those are the real weapons. Indicators are tools, accessories, and should be nothing more than secondary reasons. Everything else, every glowing signal he relied on, was a knife cutting into his ability to win. But by the time he understood, the account was empty. The lesson had already been paid for in blood and money. Jones sat quietly, staring at a dark screen. He had failed, but inside that failure was his awakening. He realized that to survive in this brutal market, he had to learn to face the chart naked, to observe price action, to read volume, to analyze context, and to act differently from the herd. Indicators are not the key, they are bait. And anyone who trusts them too much eventually becomes a victim. Indicators are an unavoidable part of modern trading. Millions of traders around the world treat them like lighthouses, guiding them through the chaotic ocean of financial markets. MACD, RSI, EMA, SMA, Bollinger Bands. Each tool promises clarity, promising to help identify trends, buy and sell signals, entries and exits. But the real question is this: do these signals actually lead to sustainable profits, or are they simply illusions of safety? A broader look reveals that indicators sit on two completely opposite sides: helpful yet dangerous, useful yet easily abused. In theory, indicators are mathematical formulas designed to summarize price data, sometimes combined with volume, to give traders insights into the market. They help visualize momentum shifts, overbought and oversold zones, average volatility, or overarching trends that might be difficult to see with the naked eye. And for beginners, they can serve as training wheels, tools to understand basic structure and build observational habits. But a deeper look exposes their limitations. First, indicators reflect the past. They do not predict the future. A moving average only tells you where price has been. RSI and MACD show previous buying or selling strength, while divergences highlight past imbalances. No formula on Earth can anticipate every future market move across all environments. If you use indicators as a compass to profits, you're putting yourself in a position to act late, move with the herd, and become an easy target for those who control liquidity. Another hard truth: indicators create the illusion of certainty. A buy or sell signal, a divergence, a golden cross, these give traders false comfort. They trick your emotions, making you believe your decisions have been objectively confirmed. But the market doesn't pay for false certainty. It pays those who observe raw price behavior, smart money flow, and contextual structure. Indicators are just a small piece of the puzzle. When you rely on them too heavily, you become blind to the real signals, miss major opportunities, or get stopped out with surgical precision. There's also the crowd effect. Indicators gather the attention of thousands of traders. When the herd watches the same signal, their actions become predictable. Smart money, funds, institutions, market makers know exactly where that attention clusters, and they exploit those areas to harvest liquidity. This isn't theory, it's a brutal reality. Indicators don't generate profit for you. Sometimes they simply spotlight where your capital sits waiting to be taken. So what role should indicators play if not the primary one? For starters, they can confirm price action, but they should never be the main reason for entering a trade. If signals from EMA, MACD, or RSI align with price action, volume, and proper market context, they can add confidence. But the core remains the same. You must observe the market directly. Spot swing highs and lows. Identify supply and demand zones. Watch real breakouts. Recognize volume spikes. This is real-time information, something indicators can never replace. Another critical point is psychology. When traders rely too much on indicators, they surrender independent thinking. They stop seeing charts with their own eyes and brains. They see flashing colors and mechanical signals. They react instead of anticipate. They follow instead of lead. They become emotionally controlled. Fear when a sell signal appears, greed when a buy signal triggers. This reactive mindset is why so many retail traders fail. They act like the herd, and the herd is always harvested. To be fair, indicators aren't inherently bad. When used properly, they can help beginners identify key zones, visualize momentum shifts, or double-check decisions. The key is balance, not dependence. A skilled trader knows how to blend price action, volume, context, and indicators. No indicator should ever be more than 5% of your decision-making. The remaining 95% must come from real data and real behavior. Ultimately, financial markets are complex, volatile, and unforgiving. There is no magic formula, no perfect indicator, no holy grail setting. Flashing signals, colorful lines, divergences, golden crosses, they are secondary. The real edge lies in observation, reasoning, and independent thought. Successful traders see the market with their eyes, analyze with their minds, and act with trained instinct, not with delayed signals followed by the crowd. So here's the message: respect indicators, but never depend on them. Learn to read price action. Learn to interpret volume. Understand market context. Use indicators only as the final confirmation, not the foundation. That is the path to long-term survival and sustainable profitability. If you found this valuable, subscribe to Trading Mindset Lab for deeper analysis, real-world strategies, and critical lessons on trader psychology. Drop a comment below and share your experience with indicators. Have you relied on them too much, been misled by signals, or learned to detach and think independently? Your story could help others improve. And finally, turn on the notification bell so you never miss a breakdown, from market behavior analysis to strategies built on price action, volume, and context. The market never offers certainty, but if you observe correctly and act with clarity, you can survive, profit, and escape the cycle that has trapped millions of traders. Indicators are tools. Price action, volume, and context are weapons, and only you can decide which one controls your results.